In this video, I tell you about material weaknesses. So what is a material weakness? Well, it's any internal control deficiency that would allow a material misstatement to occur. So how can material misstatements occur? Well, there's really two ways. One is error, and the other way is through fraud. Now, the first one, error, that's easy. With fraud, there's really two components of that part. One is a manipulation and intentional manipulation of financial statements. That can be fraud, or it's the theft of assets. That can be fraud. So if we look at internal controls for a business, and those controls would allow a material misstatement either through error or fraud, then we have a material misstatement. And if we have a material misstatement, what must you do? Yes, you must report it. Now, you have to report a material weakness in writing, and we can do that either in the internal control communication letter, some people call that a SAS 115 letter, or if you're doing a Yellow Book audit, you should report it in the Yellow Book report. Now, that's true whether you have a material weakness or a significant deficiency. In this video, we're focusing on material weaknesses. So if you're doing a walkthrough in the risk assessment stage of the audit, you're planning the audit, and you're looking at, say, the receivables and revenues part of the business, and you see that John Davis, he's billing, he's also collecting payments, and he's reconciling the bank statement. He's got full control of that cycle. We call that a lax segregation of duties. If John can do all those things, then yeah, he could steal money that in a material fashion. So as you're doing your audit, you compute materiality, right? And let's say that number is $150,000. In this instance, if you see that John could steal more than $150,000, then you have a material weakness, and that has to be reported. But what if there's some kind of control and it allows you to see that John couldn't steal more than 150? Maybe he could only get up to 100,000. Well, then you have a significant deficiency. So when you look at the control and it's not designed right, or it's not working right, and it would allow an error or a theft of more than 150 in this example, you have a material weakness. Now, let me highlight something here as we're talking about material weaknesses. Usually you're going to find material weaknesses, at least my experience has been, you're going to see those as you're doing your walkthroughs. But another place that you might see a material weakness is when you create proposed audit adjustments. So let's talk about that first piece, the walkthrough. We're required to do risk assessment procedures. We're required to do walkthroughs in those areas where we're going to risk assess. Now, commonly that would be cash, it would be receivable/revenues, it would be accounts payable/expenditures or expenses, it would be payroll. So those more significant transaction areas, we're going to do a walkthrough. We're looking at transactions, how they get initiated, and then how they get processed through the accounting system. Now, this isn't just some academic exercise. We're actually looking at the controls as we watch transactions get processed in the system to see whether or not a material misstatement could occur, or even something less than a material misstatement. we want to know that those controls are designed right and that they've been implemented. They are in use in a manner that would prevent misstatements. So you do this risk assessment procedure called a walkthrough, and oftentimes as you're doing that, you're going to see control deficiencies. At that time, you want to sit down with your client and say to them, hey, this is what I'm seeing. Am I seeing this correctly? In other words, could a misstatement occur? Do you agree? And I'm talking to my client, do you agree that a misstatement could occur? Now notice I keep using the word could. It's not that the misstatement did occur, it's whether or not a misstatement could occur. So if it can occur, then the next question is, would it allow a material amount to occur? And if yes to both of those, then you've got a material weakness. Now, if you identify this material weakness, what I would do, at that time, I'd sit down and go ahead and write the finding. In other words, how you're going to communicate this in the internal control letter or in your Yellow Book report. So you've had this conversation with the client, you draft how you're going to communicate it in writing, and then you provide it to your client and get them to read it. You want to do this to make sure that there's no misunderstanding. Another tip here is, if you're a staff person, run this by your in charge or maybe the partner on the job before you get very deep with your client about whether or not there's a significant deficiency or material weakness. You may want to chat with the in charge before you take these next steps with the client. You definitely want to talk to the in charge and partner before you draft the finding in writing. And then you give it to the client. Client will look at it. Most of the time they'll say, yes, what you've said is right. Now sometimes they'll say, no, that's not correct. And then you'll say, okay, help me with this. And then you'll continue to work on that finding until you feel comfortable with it and your client is comfortable with it. Now, if your client says, I don't want you to report this, well, that's not a call the client can make. That's a call you will make. You just want to make sure that the finding is factual, that it's correct. But you're required by professional audit standards to communicate in writing material weaknesses. So you need to do that. Now, the second place that I said that you might find material weaknesses is in your proposed audit adjustments. So, let's say you're doing this audit with $150,000 materiality and you post a journal entry for $400,000, or you propose that amount. Well, obviously you're going to give this proposed adjustment to your client, let them look at it, see if they agree with it. If they agree with it, well, what does that tell you? Yes, we have a material weakness. Now, why am I saying that? Well, if there's a material error, how did that happen? Well, it happened because there was a material weakness in controls. Otherwise, there would be no material adjustment. So when you get toward the end of the audit and you're looking at your proposed audit adjustments, just think to yourself, are there any proposed adjustments here that are greater than my materiality amount? In this example, $150,000. If there is, then we've got a material deficiency in internal controls, a material weakness, And then we go back through that process of writing up the finding, communicating with the in-charge and the partner, communicating with the client, and now we have a finding. So let's go back to where we started in the video before we close this out. So I was asking, what is a material weakness? So a material weakness is any internal control that has a design flaw or it's not operational during the year, and it would allow a material misstatement either through error or through fraud. And we said that through fraud, that could happen through an intentional misstatement, the client's cooking the books, or a material theft of assets. So there you go, material weaknesses. I hope that helps you as you perform your audits in the future. By the way, as I close out here, think about all of this in light of peer review. So one of the things that peer reviewers look for is, did you do that walkthrough? And then some of them actually look at your proposed audit adjustments if they're material and you don't have a material weakness communicated. They may ask why. So think about this process of identifying material weaknesses and communicating material weaknesses in a proper manner. Also, one last thing, look at your audit file and see if it is congruent. I looked at a file this morning and I noticed the Yellow Book report had 3 material weaknesses, but when I looked in the audit file, there were 4. So if there's 4 identified in the audit file and there's only 3 in the Yellow Book report or that SAS 115 letter, something's wrong. They haven't communicated all 4 of the identified material weaknesses. So you want to make sure your work papers are congruent with the Yellow Book report or that SAS 115 internal control letter. So good to be with you today, and until we meet again, take care and bye now.